Hey everyone, Sean here. Welcome back to Prompt to Profit. Last episode, we tried fixing Tesla's brutal drawdowns with percentage trailing stops. Spoiler, it made things worse. Here is the problem. On a stock like Tesla, 15 to 25% swings are just Tuesday. A tight stop doesn't protect you. It shakes you out and you watch the stock run without you. The misgains pile up until they exceed whatever the stop was supposed to save you from. So today, we're asking Claude for something smarter. A stop that actually breathes with the market. Let's see what it comes up with. I gave Claude our existing code and explained the problem directly. Fixed trailing stops don't work on high volatility assets. I need a smarter approach. Claude immediately diagnosed what was happening and laid out 3 alternatives. The one that caught my eye, ATR-based trailing stops. ATR stands for Average True Range. It measures how much a stock actually moves day to day. If Tesla normally moves $5 a day, the ATR is around 5. During earnings season, it might spike to 15. Instead of trailing by a fixed percentage, you trail by a multiple of ATR. On quiet days, the stop tightens. On wild days, it loosens automatically. A fixed stop treats every market condition the same. An ATR stop adapts. That is the whole difference. Claude also flagged something I didn't expect. This technique already has a name. It is called the Chandelier Exit, used by systematic traders since the 90s. We're not inventing anything new. We're rediscovering proven tools with AI's help. And that is the whole point of this series. Claude suggested a parameter grid. ATR periods of 10, 14, and 21, crossed with multipliers of 2.5, 3, and 4. 10 days is 2 weeks of trading. 21 covers a full month of volatility. The multiplier controls how much room you give the position. 9 combinations. Let's see what the data says. The code is straightforward. Calculate ATR. Multiply it by the factor. Trail the stop below the highest high by that distance. If the highest price is $100, ATR is 5, and we use 3 times the stop sits at 85. As the stock rises, the stop also rises. As volatility increases, the stop gives more room. When price breaks through, we exit. That is it. No magic. Just volatility-aware logic. Backtests. $100,000 starting in 2011. Baseline. ATR 14 with 3 times multiplier. 2,023% profit. 67% drawdown. 171 orders. Now, let's give the position more room. ATR 14, 4 times multiplier. 5,728% profit. 67 orders fewer. Drawdown dropped to 66%. Fewer trades, much bigger gains, and already trimming the drawdown. The looser stop let winners run instead of cutting them off. Now, the one that really stood out. ATR 21 with 3 times multiplier. The classic Chandelier Exit. 8,787% profit, nearly $9 million from a $100,000 account. And the drawdown came down to 59%. That is a meaningful improvement over the 66 to 70% we saw with fixed percentage stops in Episode 2. Sharp ratio of 0.79. Best we've seen in this series for Tesla. More profit, less risk. That is exactly what we were looking for. In Episode 2, the best fixed trailing stop on Tesla topped out around 2,000 to 4,000% profit with worse drawdowns. The ATR approach more than doubled the profit and reduced the drawdown at the same time. Same stock, same period, smarter exit. The full grid confirms the pattern. Higher multipliers win almost without exception. How about the 2.5 multiplier setups? 12 to 1,400%. On paper, they feel safer. Tighter stop, more protection. But here is the same counterintuitive result we found in Episode 2. The tighter multiplier actually generated more drawdown. 2.5 configs generated over 200 orders. 4 times multiplier gives us around 100. More exits means more re-entries at higher prices, and the whipsaw compounds. Half the trades, 4 to 6 times the profit. The tighter you grip, the more you lose. One more observation. ATR-14 underperformed both shorter and longer periods. You either want a reactive short period stop or a smooth long period one. The middle ground gave us the worst of both. Let's see if the pattern holds on something less volatile. QQQ, the NASDAQ 100 ETF. Same code, same grid. Best result? ATR 10 times 4, 693% profit. Across the table, higher multipliers outperformed tighter ones again. The concept held. And unlike Tesla, where it was mostly about raw returns, here the 10-day 4 times setup also had the best sharp. Higher profit and better risk, adjusted returns in one configuration. That makes the signal even cleaner for QQQ. Looser stops won across the board, not just on profit but on consistency too. The optimal parameters shifted from Tesla, but the direction was the same. Give the position room to breathe and it performs better. And ATR 10 times 4 was a strong performer on both assets. That kind of consistency across different tickers is a meaningful signal. At this point, I got greedy. I went back to Claude and asked, can we do even better by protecting profits in stages? Claude laid out the tiered protection concept. Use different stop logic depending on how far in profit you are. Below 15% profit, tight stop to protect capital. 15 to 30%, move to break even. Above 30%, let ATR trail freely. Claude also suggested a partial exit. When the stop triggers, sell 50% and trail the rest with a tighter stop. Lock in some gains, let the rest ride. Sounds logical. More rules, more control. Let's see what the data thinks. 5 configurations on Tesla. The best tiered setup returns 6,753%. Sounds good. Until you remember the simple ATR 21 times 3. Hit 8,787%. 2,000% of profit gone from adding complexity. And the drawdowns? Tiered configurations hit 66 to 72%. That is barely better than Tesla buy and hold at 73%. The whole point was to reduce drawdowns. I tried reducing the partial exit from 50% to 25%, thinking letting more of the position ride would help. It got slightly worse. 6,498% profit, 72% drawdown. So why did more control hurt us on both ends? Partial exits cap your upside during the exact runs you are trying to capture. Tesla makes multiple 200+% moves in a single trend. When that happens, you want every share working for you. Selling half mid-trend means only half your capital rides the wave. And the early profit-locking tiers force you out too soon on the big winners that drive most of your returns. The complexity didn't reduce drawdowns. It just reduced returns. You got ripped twice. Simpler was better, by a lot. Zooming out across everything we tested. ATR with period of 10, 14, 21 days. Multiplier 3 versus 4. The differences were real but not dramatic. Results clustered. When that happens, it means the concept is doing the work, not the exact numbers. That is called robustness. If a strategy only works with one precise configuration, that is a red flag. It probably just fits the historical data and will break on new data. When it works across a range of parameters, you have a real edge. Fixed percentage stops fail on volatile assets. ATR stops adapt. That is the core finding. Higher multipliers consistently outperformed. Tighter stops felt safer but created more whipsaws and worse outcomes. More complexity hurt. 2,000% of profit and worse drawdowns, just from adding tiers and partial exits. Each new rule adds a parameter. Each parameter adds overfitting risk. And each partial exit shaves potential gains. In trading, the urge to add more conditions is strong. We should resist it. I only tested Tesla and QQQ. Try it on other tickers and drop what you find in the comments. 3 episodes in, we've gone from buy and hold baselines, to moving average gating, to fixed trailing stops, to volatility adaptive exits. Each step we brought a question. AI helped us explore it faster than we ever could alone. That is the workflow you think AI helps us build. Data decides. We're not done. There are more ideas to test, more strategies to explore. Come back for the next one. I promise it'll be worth it. If this was useful, subscribe and drop a comment with what you want to see tested next. Code is on GitHub, link in the description. Follow me on X at AI Quant Studio for updates. I am Sean. See you in the next one.